Good morning, everyone, and thank you for joining us on Morning Markets from True Potential. Today, I just wanted to continue that theme of the discussion from yesterday, where we discussed the debt ceiling in the US and some of the discussions that have been ongoing there, which now do appear to have pushed that challenge that needed to be addressed further out into the latter half of this year. That, along with natural gas prices coming off a little bit more yesterday, certainly improved sentiment in markets, and we saw that in terms of how equity markets performed, with equity markets across the globe up anything between 80 basis points and 2% on the day. That's despite the continued move up in sovereign bond yields that we've seen. Yesterday we looked at the chart of how the UK 10-year gilt had moved over the past couple of weeks. Very similar dynamics when we look across other countries as well. So looking at the US 10-year Treasury moved out closer to about 160 yesterday, getting us back to or closer to those levels that we saw a number of months ago. Similar picture in Germany as well. Cast our mind back a couple of months ago, we were thinking about the German 10-year bund moving into positive territory. We're not there yet, but we're much closer than we were 3 or 4 weeks ago. Just the other dynamic that we've also been discussing is that of inflation, how inflation has continued to maybe be slightly higher than people had been expecting, and maybe more long-lived with us than that transitory view that had been expressed. We heard from the Bank of England's new chief economist yesterday for the first time. Very interesting comments that he was making around his view on inflation, and I'll just read some of his comments out. And he talked about, in his view, that the balance of risks is currently shifting towards greater concerns about the inflation outlook, as the current strength of the inflation looks set to remove more long-lasting than maybe initially expected. That certainly sets a very interesting tone for the Bank of England's meetings over the coming months, and whether we will see the Bank of England have to move earlier than expected in terms of reducing the QE programme than have been expected. So we'll see how that plays out over the coming number of months. The other thing I just wanted to touch on this morning, just looking into Asia, China's services, cast our mind back to last month. The Casson survey was very disappointing, coming in at 46.7, below 50, signalling a contraction in activity. For September, we've seen actually a good rebound in that, back above 50 at 53.4. Speaking to the fact that then that slowdown in services activity last month was very much a function of the closures that we were seeing in the Chinese economy to deal with COVID outbreaks, and that very sort of strong zero COVID policy that's being introduced and followed there. Looking to the day ahead, very much about the US jobs report for September. Cast our mind back to August when that report came out. It was very disappointing. Looking for 500,000 jobs to be added in the US today. Certainly be very interested to see how both the equity market and the bond market react to a number that's either side of that 500,000. I'll leave it there on markets, and then of course the key thing from here in Newcastle has been the takeover of Newcastle United by the Saudi Sovereign Wealth Fund. What we will see from that, we'll have to wait and see, but if we look at some other areas where we've seen that occur, it certainly does lead to investment in the region. Please join us again next week. Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.